The broadcast is now starting. All attendees are in listen-only mode.
Welcome to the final installment of our 2019 webinar series. This year's webinar series included client stories, your client stories, and how these stories can help you and other clients in this year and beyond. This webinar will last about 50 minutes, and you must be logged on for a full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We'll do our best to answer them as they come in. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. Today's presenter is constantly monitoring the insurance and financial services industries to ensure your clients are getting the most up-to-date recommendations. In 2013, he joined LLIS with his CFP and MBA and has been leading as president and CEO. Here's Mark Maurer.
Hi, everybody. It's good to be here in December. It's fun to have been working with all of you through the course of the year. And today we're going to have our last LLIS webinar of the year. And part of the end of the year, we're going to look at things to consider for next year. And very excited to in a way, wrap up last year. 2019 was a good year for, I think, a lot of reasons. And I hope 2020 is going to be great too. And it's December here in Tampa, Florida. Christmas, New Year's looks a little bit something like this. We have ornaments there on the beach and Santa there in shorts out on the beach. So Claudia, who was introducing me, I think has 50s and for the highs and 30s for the lows today. I won't tell you what our highs and lows are going to be today. Let's just say for about the next 4 or 5 months, it's great to be here. It's the other 6 or 7 months that, kind of wish I was someplace else. But I digress. Today, we're going to talk about insurance. And thinking about things for the next year, we're going to talk mostly about reviewing existing policies and what we can do with existing policies, whether it's taking an existing policy and changing it or changing to a new policy. So we're going to talk about term insurance, disability insurance, permanent insurance, in this case universal life coverage, and long-term care insurance. And so for term, a lot of times we're doing reviews, and the first question we want to ask is, does it still fit? Your clients and even you personally, you may get a term policy with a 20 or 25 or 30 year level term period, and just assume that that's going to be exactly what we need for the next 2 or 3 decades. We hope we're right. A lot of things change, but many times we're looking at it and wondering, is it still a good fit? Is the amount still correct? We got some coverage a while ago based on our income at that point in time. Has our income significantly increased? Have we added more debt? How many more children do we have? All of these are things that factor into, is the amount of coverage that we have still a good fit? How about the term length? You may have a client who purchased a 20-year term, but actually really needed it for 30 years. And so they're 15 years in, looking at a 5-year time horizon on the policy, and really they need it longer. So what do we do? Do we add another policy to their existing policy? Do we replace that policy that's going to end shortly with a whole new policy? And the rate class. Very few of us we'll all get older, and very few of us actually get to be in better health as we get older. So for your clients who have a term policy or life insurance policy issued a few years ago at a preferred or preferred plus rates, those are usually keepers. And I'll talk about keepers a couple times, I think, through the course of the talk today. But a preferred plus a few years ago, most of the time you can't beat that today. And so those a lot of times are keepers. But maybe client got a standard class a few years ago, and maybe they've lost weight, maybe they've stopped smoking, maybe there have been some habits or things that have changed. Maybe there's a way to update or upgrade that policy to a preferred or preferred plus rate class. So that's sort of individual policies that your clients have, and the general way they work, fixed term periods, rate classes, that sort of thing. Next thing I want to talk about is group term. And I had an advisor come to me here recently, introduced us to her client, David. And Dave is age 60, and he has $200,000 of group life insurance that he's paying $204 per month for. And the advisor's question was, this seems kind of high. What do you think some options might be for Dave? And is there something we can do that might be better? Part of this whole review of the group term goes back to how group term works, or group life insurance. There's generally 3 layers of employer provided life insurance. The first $50,000 the employer gets to deduct. The employee doesn't have to recognize anything as income. So that first $50,000 is a win-win both ways. There can be a second level where an employer may pay an additional 1 or 2 times salary for employees, and the employer gets to deduct it. The employee has to recognize some premium on their tax returns. So while they don't pay the premiums, they pay tax on the premiums, which is still pretty much a win. If I could get a new car and only pay the tax on the car, if I was on the Oprah show and she said, you get a car, and I was in the audience and I said, I get a car, you get a car, but then you owe tax on the car. That's still a win. So if somebody says, here's something, all you have to do is pay the tax on it. In this case, it happens to be life insurance, a lot less exciting than a car, then it's still a good deal. Then there's a third or tertiary level of life insurance, and this is employer, we'll call it sponsored life insurance that the employee pays for. And the employer isn't paying for it, so that's why I said employer sponsored, but the insurance company who generally is providing those first 2 layers says, okay, and here's a third level that if you'd like to pay for it, you can, we'll offer it to employees. Generally limited to no underwriting, and it has rates banded in 5-year increments. And so when you're in your 20s and your 30s, it costs very, very little, and it's included on your paycheck every other week. $2, $3 a month. It's hardly anything. But then when you reach age 30 or 35 or 40, the rates for that coverage go up. And usually, because these aren't 5% a year or 2% a year, it's big jumps at these blocks, 20 to 40%. So when you go from 26 to 31, they may not be big jumps. 30 or 40% on $3 a month isn't huge. But then when it gets to your 40s, then these jumps really are starting to compound. So pretty much when anybody's in their 40s, look at new term. Same amount of coverage, level term coverage can usually provide the same benefit with a lot more stability, locking in that level term period, and the client can pay the same or even less for that individual coverage. Plus, they have the individual coverage in case they leave their employer. So lots of benefits to it, especially starting at age 40. But this is the coverage that we're talking about for Dave. He's paying for it. And just as some background or color, Dave had some questions. He asked, is there underwriting involved in this? I'm thinking maybe because group coverage, there's many times little to no underwriting, just didn't want to go through it. Said, yes, here's the different things. Here's things that might be required. He said, what about medical records? Are medical records going to be ordered? And I said, yes, more than likely, but seems like you have some sort of specific questions. Let's maybe have a call to find out what it is. Well, he sent me an email saying pretty much what had happened is he'd been declined by the AICPA Association for their term life insurance program because of all this stuff. I threw it up there. Now, I looked at all that, and I've been doing this for 16 years now. I looked at all of those details, and I analyzed it, and I looked at it very carefully. And I said, huh? Because I know what I'm good at, and knowing what an Agatston score is of 147 is not one of those things. So what did I do? I called some underwriters, and I said, I have a male age 61, and here's the details of the information he gave me. Sent it out to a handful of companies, and 4 of them said, based on that information, now we don't have his medical records, we don't know a lot of things, but given that particular information, he might be eligible for standard rates. So I thought, hey, that's pretty good. Started reaching out to Dave again, and for his $200,000 of group term, he's paying $204 a month, and we know he's 61. Those rates are going to increase again at age from 64 to 65, increase again when he goes from 69 to 70. So we know that in the next 10 years, there's going to be at least 2 more rate increases. So at standard rates, we looked at a new $200,000 10-year level term policy. Depending on the insurance company, those 4, their estimated premiums are somewhere between $108 and $130 per month. That's pretty good. And he said, wow, those look great. How about a 30-year or $300,000 10-year term? $151, $175. How about a $400,000? $199 to $231 a month. So can get maybe double the coverage for about what he's paying now on the group coverage. Vice versa, can pay half of what he's paying now for about the same amount of coverage if he keeps it at $200,000. So that's pretty neat that we're able to work with advisors and clients, find these scenarios where we can really help. It's not $5 a month or $4 a month. We're talking about 50% less, assuming that we can get Dave underwritten. So part of this is, why does this work? Well, with the group coverage I mentioned, it may have little to no underwriting. And so the insurance company says, I'm going to offer coverage to everybody who's working at ABC Employer, and I'm not going to ask any health questions. So I can't assume that everybody's a super preferred. I can't even assume that everybody's a standard. I probably have to assume that some of these people are really not in good health, and so everybody pays one rate that factors in some super preferred, some averages, and some unhealthy people. So that's how we get to Dave's $204 a month. Pretty much you're healthy enough to be working, but we don't know if you're had a heart attack last week. So that's where that rate comes in. Now, how about the AICPA plan? It works not exactly on a pass-fail basis, but a little bit like that. It may offer a few rates. There's a preferred rate, there may be a standard rate, but many of the association plans don't have ratings or flat extras, super preferred rates. They may have one better than average rate, one rate that covers average and maybe a little bit below average, but beyond that, their pricing is not designed to build in things like individualizing premiums, a table 2, a table 3, a standard plus. May not be priced in to be able to order medical records. So the insurance company on some of the association plans are going to say, if you fall into this category, we'll offer a preferred. If you fall into this category, we'll offer a standard. But outside of those categories, we don't really have any other pricing options, so we'll pass. Basically a decline. So because it may not ask a lot of health questions, or have a few questions but not a lot, The association coverage may not offer coverage. The group coverage may be pricey. And with an individual policy, because we can get, the insurance company can look at his medical records, can ask for current lab results, get a lot of information that's very specific to Dave at this point in time, they might be able to offer rates. And the good news is that with the group coverage, Dave has it. Let's say we apply to an insurance company and things aren't as beneficial as his medical records show that things are more significant than we know at this point. He may not be offered coverage again, but he can still keep the group coverage. And so even if we apply, we're trying to see, can we make the situation better? Nothing is being given up, so there's nothing taken off the table, or there's nothing that he loses by applying for new coverage. We're just trying to see if we can make his situation better. And if anyone has any questions, please feel free to type them in. I forgot to say, please type in any questions in the little question box there on the GoToWebinar panel. I will do my best to answer them as we're going along. Okay, so that was term life insurance, group term. So we're going to talk about disability coverage now. And again, reviewing disability policies has some of the similar things. We're looking to see, is it still a good fit? Does a client have group coverage? So there's two ways we might think about this. If a client already has group coverage, do we add it on top? Do we add additional coverage on top? If they don't have group coverage, how do we design a policy to fit those needs? But let's say they do have group coverage, and then we want to add supplemental individual disability coverage on top of that. Well, now why do we do that? Well, partly because they may have higher income to protect. And there's two ways I think about higher income. One is that most group plans have some caps. They have maybe a 60% of income up to $5,000 a month or $10,000 a month. For your client who is a high income earner, their income that 60% and that $10,000 a month cap, they may have already hit that cap. So they have, as their income grows, they have a higher proportion of coverage that isn't being covered by the disability. Or maybe they have a disability policy, but their income has grown, but the disability policy has stayed the same. So is there more income to protect? Maybe they're able to be considered in a better occupation class today. Financial planners are a good example of different rate classes. Some companies have two occupation classes, and the occupation class determines the cost per dollar of coverage that you'd pay. And a financial planner who maybe has earned earning $75,000 or $100,000, and who has been in the industry for 4 or 5 years or more, may be in a better occupation class than a new financial planner who doesn't have that level of stability. And so a few years later, a few years after having a policy, we may be able to go back to the insurance company and see if we can get that rate class reviewed, equaling a lower premium, in this case probably for you since you're financial planners. Has their existing insurance changed? I'm going to, a little foreshadowing, that's how I'm going to talk about the next client. But as someone's income goes up, has any of the existing coverage changed, and how do we do our best to keep that disability policy in line with their current income? So here's Lindsay. When she started working with us, her advisor introduced her to us, and she was age 33, and she was an IT consultant working for an employer, and she had group coverage through that employer. So in 2017, when we started working with Lindsay and her advisor, she had $180,000 income and had group disability benefits. But having listened to to us talk about the value and of individual disability coverage to supplement group coverage. Lindsay and her advisor asked us to help put an individual disability policy in place. And so Lindsay purchased a supplemental disability policy that had an $1,800 monthly benefit. So between her income and her group coverage, there's a gap. So this supplemental disability benefit of $1,800 a month covered that gap. Now, this policy also had a benefit increase rider. And this is where we're going to talk about a little bit more because things changed in Lindsay's situation. So, what is that benefit increase rider? It's a particular name or version of a disability increase rider. What are disability increase riders? These are neat riders attached to a disability policy, and it protects the insured's ability to increase this disability policy even if they've had changes in health. So it guarantees the ability to purchase additional disability coverage based on financial justification only, but without having any medical questions or medical underwriting. And that's the real, I think, important part of this. So as income increases, the policy has the ability to increase coverage based on higher income, but with no health questions. So as income increases, even if someone's health has declined, this rider lets the insured purchase additional coverage to keep that monthly benefit in line with their new income. So with this particular rider, a little bit of details about it because it helps frame what Lindsay actually did with the policy. But this particular rider is a benefit increase rider. It had a no premium design rider. So it's included on the policy, but it doesn't cost her anything to have. When you have free things, there's usually a little more, restrictions or not necessarily restrictions, but qualifiers to it. If I pay for something, it's probably more flexible. If it's, in this case, it's just included on the policy with no premiums. And so that's a nice thing. How does it work? Well, in order to keep the rider, you must apply for this rider every 3 years. So even if you think my income hasn't gone up, or probably hasn't gone up enough to justify any sort of increase, you still have to go through the process. You still have to go through the paperwork to keep the rider on the policy. Like I said, it doesn't cost you anything to have, but you have to do a little bit of work to keep it. So you have to go through the forms, go through the information. And then the insurance company looks at your current income, your existing coverage, might be group coverage, this policy, whatever else you have going on, and determines your eligibility. And it can be $4,000 a month, it can be $10,000 a month. And they calculate the eligibility, say you may be able to increase your disability policy by $5,000 a month based on your higher income and all your existing coverage that you have in place. But you must increase it by at least 50% of what you're eligible for. So the calculation was you're eligible for $5,000 a month, must increase the policy by $2,500 this year in order to keep the rider. Why is that? Well, if we take it to an extreme, if people could exercise all of the increases at any point in time, what would we all do? We would not exercise, and then when we have a heart attack, get diagnosed with cancer, have, something happen in life, then we'd exercise that full $10,000. That's adverse to the insurance company because then you're basically just letting people buy coverage only when they're unhealthy. So again, there's this little bit of qualifier that says, really, if you want to use this, then you should be accepting some of it along the line as time goes on every 3 years to keep up with your income if you really think it's valuable. So there's that, must accept half of what you're eligible for. Now, calculations are you're eligible for it every 3 years, or there are alternate exercise dates built into the rider. And one of those is a loss of group disability benefits. And the ... dots right there is the foreshadowing of where we're going with Lindsay. Because last year, when Lindsay was age 34, she came to us. She was still making about $180,000, but she'd moved to a new employer. And this new employer did not have group disability benefits. What did we do? Lindsay and the advisor came to us and asked what we can do. We said this policy has this rider. It's eligible for that alternate or early exercise of, because she lost group benefits, she has the ability to exercise this benefit increase rider early. Based on her income, she was eligible for an additional $7,000 per month in increases on top of what she already had. And she said, looked at that and said, maybe a little more than I want to spend right now. So what she did is she added that 50% of that, the sort of the minimum she could, the $3,500 to fit her budget. And so she increased her policy by $3,500. Her premiums went up, not as much as if she'd exercised the whole amount, but the rider is still there, available on the policy, and she was able to increase her coverage because she'd lost the group coverage there. And here are 4 of our lovely policyholder service team people, Neva, Taylor, Ashley, and Ahmad. So we have 4 people here in our office who are helping you and your clients keep track of these updates. If they have alternate elections, if someone loses group coverage, please let us know, because we can check the policies, see what they might have available. We can also let you know and let the clients know when some of these options may be available so that they don't lose them accidentally. We can do a lot. We can let you know, we can let the clients know all of these things that are available, and then you all have the information, the best information to make decisions going forward. A question: what if you exercise the rider, but it puts the benefit limit above the 60% of income limit? I will answer the question how I think, what I think the question is. So if someone has that $180,000 of income, the insurance companies have calculation tables that say for someone who's making $180,000, we would offer X amount of disability coverage. And that's some number. If someone has group coverage, that's offset from that amount. If someone has another individual policy, it's offset from that amount. So the insurance company may look at it and say someone has group coverage of 60% and an additional $1,000 of supplemental coverage. If they didn't have that supplemental coverage, we'd offer $2,000 a month. But because they have that supplemental policy, we'll offer an additional $1,000 a month. So the 60% is not necessarily a hard and fast rule as far as insurance companies go. For group coverage, there's usually that specific amount. So group coverage usually says it will be 60%, not to exceed $10,000 per month. An individual policy usually has more generous guidelines that it might go higher than that. And so that's where we get that supplemental coverage that can be more than what the employer plan might have. So hope I answered the question. All right, next thing we're going to talk about is permanent life insurance, in this case, universal life insurance. What to do with an old universal life policy. And you know what? There we go. Somebody has an existing life insurance policy. They want to take a look at it, want to make sure there's some changes or see if there's any changes they want to make to it. And so that's part of where we come in. So Ken and Shirley, they have a $2 million MetLife survivorship policy from 2001. They hadn't paid premiums in a while. And going back, variable policies from 2001, and I'm guessing this was in early of 2001, probably had an 8%, 9%, 10% projected rate of return all years going forward. And you know what? When you project anything at 10% all years, it looks really good pretty much all the time. So my guess is that when they had this policy put in place originally, it was projecting they were going to pay 10 years and at 10% it was going to do whatever. And they probably did that, didn't necessarily look at it. Things not, I can hypothesize all day long, but they hadn't paid premiums in a while, and they had $189,000 in cash values. And so we helped them. They're both 68. So we helped them get some in-force illustrations. And so we helped clients and the advisors request 2 sets of in-force illustrations, because these are the things that we want to know. If they want to keep this policy, what should we expect going forward? Well, first, we said, let's assume a 6% gross rate of return all years. Different advisors use different numbers. That's pretty standard. So we said, let's not assume a 10% or whatever it might be. Assume 6% gross hypothetical rate of return in this variable policy all years. And if we want to keep the $2 million policy, what should they start paying now to keep it going to their age 100? Now remember, they hadn't been paying premiums in a while. And so that new number was to start paying almost $28,000 a year going forward. When you haven't paid premiums in a while and somebody says you need to start paying $28,000 a year, most people aren't super stoked about that. And knowing that that was an option, we'd requested a second illustration that said, if we wanted to pay no future premiums, and again, assuming that same 6% rate of return all years, let's reduce the face amount so that it carries to their age 100, just a little bit of cash value at age 100. What face amount should we reduce the policy to make that happen? And in that case, reduce the policy to $870,000, no premiums, and the cash value that's in the policy plus the earnings is going to pretty much run it to their age 100. That's the no future premiums option. Keep it at $2 million, pay $28,000, reduce it to $870,000 with no future premiums. But by working with the client and the advisor, realized that they were not excited about the volatility of the policy. It'd been variable for almost 20 years. It wasn't where they wanted it to be, thought it was going to be. It was a policy and a trust for their kids, and said, we really would like to take the volatility out of the equation. We've got some cash value here. What can we be sure? On a policy that we're sure there's going to be a death benefit. Basically, we just want to guarantee it with this cash value and go. So we looked at a second to die, no lapse, universal life policy. So we did a 1035 exchange of their current cash values to a new policy. They're both 68, both ended up getting preferred rates, and that cash value guaranteed just over $640,000 of death benefit for their lifetimes. No future premiums, doesn't matter what the cash values do. X dollar of premium guarantees Y dollar of death benefit for as long as either one of them is alive. So until the second death. So it's called a second to die policy. So the trustee knows exactly what this policy is going to do. Trustee doesn't need to manage the sub-accounts, doesn't need to see if premiums are going to be due again. Trustee knows exactly what it's going to do. And so the trust department has a party. Look at this trust department. Does anybody notice anything about any of the people in this picture? Huh? Maybe? I notice that this guy looks an awful lot like the elf on a shelf. Okay. How about administrative reviews on life insurance policies? As we go into the new year, if you have clients with quarterly premiums on pretty much anything, I'd ask to revisit that. And from my experience, personal experience, quarterly premiums are usually a problem. They tend to get overlooked and missed. And it's not just me thinking that that's true. We got some statistics that show that it actually is true. Quarterly payments, so you see, here's the lapse rate by payment mode, and quarterly premiums are the top of all of these options. Now I can think of why. If you have a quarterly payment, you get the bill. You don't do anything with it for a while. It sits there for a couple of weeks. Maybe you get a second letter that says, hey, we really do need that premium. Now it's late. You write a check, send it off, goes in the mail. Well, by now, you're about to get the letter that says your next premium is coming due. But you think, I just paid that. It's probably a reminder of the one that I just paid, and you don't pay it. Nothing, unless you're a CPA and doing some estimated taxes, I can think of very few things in my life that work on a quarterly basis. Annually, I have a lot of things, birthdays, anniversaries, lots of things are annual, and a lot of things are monthly. Water bill, electric bill, all those things are monthly, but very few things in life is sort of a quarterly. And so, as you can see here, quarterly payments are most likely to get missed. And it also costs you more to do quarterly than monthly bank draft. When you pay more often than annually, there's a little bit of a factor, because the insurance company, what they do with premiums is invest them to pay future claims. So if a premium is $1,000 annually, then the insurance company has that $1,000 all year to invest. If you're going to pay semi-annually, then you get 500 and 500 twice a year isn't the same, because part of that earnings is not there. So it makes up for that with slightly higher payments. So semi-annual twice a year is $520 a year instead of $500 twice a year. So over the year, pay $1,040. Quarterly, you pay $1,080. But if you go to monthly, you may pay $1,056. So you can actually pay less with the monthly bank draft than quarterly. We probably don't think that that's the case. But if somebody needs to keep it on quarterly, maybe it is a trust disbursement, that's how they get their income, consider, is there a quarterly bank draft option so that those premiums don't get missed? Or, like I said, change to monthly. It's more frequent, but normally costs less than quarterly, and less chance of missed payment by far if we go back and look at this lapse rate thing right here. Anecdotally or personally, all my personal life insurance policies are on a monthly bank draft. I know that I pay more, but I've never missed a payment. I've never gotten a lapse notice or a late payment notice, because it's on monthly bank draft, and it's one less thing I have to think about. So our last topic that we're going to touch on is long-term care insurance. So there's a few things that through the course of the year that we talk about with long-term care. One of those is reviewing existing policies. And unfortunately, rate increases are a world that we live in now with existing long-term care policies. And so we regularly have advisors ask us to review existing long-term care policies. The other thing, and we'll touch on this second, is repurposing policies. When we're young, we have life insurance, and usually term life insurance, to replace income in case we were to pass away prematurely. We have disability coverage to replace lost income. Maybe we have whole life policies that are a little bit of savings, a little bit of permanent coverage, and maybe we have some annuities for some reason. when we're young. Hopefully not, but maybe we do. And when we get to about retirement age, we start to transition our thinking from worrying about earning income and transitioning to worrying about spending down what we already have. And so secondly, we're going to talk about how do we transition maybe some assets to from one need to be able to do 2 or 3 things. Provide long-term care benefits, for a client and a spouse. So the 2 things we're going to touch on, but first, an advisor here in Florida asked me to review a policy, long-term care policy for his client Laura, and she's age 79 today. She has a long-term care policy that has a $100 daily benefit, lifetime benefit period, and lifetime benefits have been not available on many traditional long-term care policies for a few years. And so right away when I see a lifetime benefit policy, I know that it's a number of years old. It has a 20-day elimination period. And again, older long-term care policies may have had a 20-day elimination period because Medicare covers certain things for the first 20 days. Or it may have had a 100-day elimination period because Medicare covered other things for 100 days. It's probably only fairly recently that we talk about long-term care policies with the 30, 60, 90-day elimination period, thinking more of having 3 months of emergency funds to be able to pay for care, rather than having the policy that's tied to specific Medicare eligibility benefits. That's hard to say twice. Kind of like Red River Rivalry Week. Whew. Realize the policy is over 20 years old. It's actually a principal long-term care policy. And I don't remember ever seeing a principal long-term care policy before. And over time, a lot of companies have had long-term care policies, issued them for a few years, maybe got out of issuing new policies, but kept existing policies on the books. And so that looks like the situation here for Laura. She has this principal policy with lifetime benefits, and she's been paying $782 per year. And like I said, unfortunately, rate increases are just something that it's just in the long-term care world, just something that unfortunately is happening. And I can get up on my soapbox and talk about that it may have been better for years ago for companies to start introducing smaller increases over time, because we all expect our health insurance to increase. We all expect lots of things to increase, rather than waiting so long and having to implement big increases. But nobody asked me back then, so there we go. But she got a notice that over the next 3 years, principal had applied to the state, Florida, and requested these rate increases. And so important to know that with the rate increases on long-term care policies, insurance companies can't just do it. They have to apply to the states and give data and explain why they've requested these increases, why they need them, why they should have them, in order to keep these policies and keep these blocks of long-term care policies solvent and able to pay future long-term care benefits to the insureds. So principal had applied to Florida and said, we need a rate increase to keep these policies viable. And it was going to be a 3-year increase from 784 last year, 2019, 2021, 1384. So ends up being a 76% increase over 3 years. That's not fun. The good part, if there is a good part to this, was that the language in the letter said that while we have these increases, we will not increase the premiums on this policy for 10 more years, for 10 years after 2021. So by then, Laura is already in her early to mid 90s. So for all practical purposes, this is probably the rate increases she'll have, and her policy will be $13.84 per year, potentially until either she goes on claim or possibly passes away. So $13.84. The question is, what would similar coverage cost today? What should we do with that? Because that's a question we get. What should we do with this policy? And I think the best way to frame it is, what would that cost today if we could do it? She's 20 years older than when she purchased this policy. And like I said, most of us don't get healthier when we get older, as we get older. And the cost for pretty much for all types of insurance goes up as we get older. So we already have the fact that she's 20 years older, so we have that we have to overcome. Price in $100 daily benefit. And again, most companies don't offer a lifetime benefit anymore. Most don't offer a 10 or 8 like they used to. Some offer a 6. I think pretty much everybody offers a 5, so I used 5 so I could compare 2 different companies. 30-day elimination period, as close to the 20 as we could get. With Mutual of Omaha, for a slightly longer elimination period and a 5-year benefit period instead of a lifetime benefit period, premium is $10,000 a year. For Transamerica, it's $12,000 a year. So this is where how I look at this and compare to it to see what is the value, or what is the sort of current value of the coverage that she has. It's somewhere between $10,000 and $12,000 a year. And even with the rate increases, she'll be paying less than $1,400 a year for it. So recommendation, it's a keeper. If it's within her ability to accept the increases, that was my recommendation, because she's got it at one heck of a discount. Now, most of the time those letters will say, if you can't afford these increases, then we can reduce the daily benefit, we can reduce the benefit period, and all those options are available. But for Laura, I'm hoping that the extra $600 a year is in her budget so she can keep this policy. So my last topic, and I call this have life, need long-term care for 2. Really could be have an annuity, need long-term care for 2, but really want to talk about when one person, partner, spouse, has some existing coverage, but they both want to look at long-term care. Then I think the annuity long-term care hybrid is really the neat thing, and I just really like talking about this because I think it's sort of just a neat way that you can repurpose existing policies that no one necessarily thinks about immediately. So the hybrid annuity long-term care policy, it's a fixed deferred annuity, and we can do a 1035 exchange from existing life insurance policies or existing annuities. It's a single premium, so clients can just write a check, but it's easy to cover spouses or partners with one policy. So it's basically an annuity. It can be a joint annuity with 2 annuitants and 2 people that can receive long-term care benefits, or it can be an annuity on one person, and you can add a spouse as somebody who's eligible for long-term care benefits, not actually attached to the annuity, but eligible for long-term care benefits. And I'm going to talk about that a little bit more. And the cool part is, if they never need it for long-term care, then it's still an annuity. There's annuity cash values that pass to the beneficiaries. So even though they paid for long-term care, got a long-term care policy, if they never need it, then you know what? There's money that goes to somebody. Or if something happens and they need the policy for retirement income, what have you, they can access the policy to do that. Like I said, it's a fixed deferred annuity, guaranteed monthly benefits, guaranteed cash values. You can have a long-term care pool anywhere from 5 years to 138 months, but you can add a spouse. And that's sort of where my aha moment came in, and why I think this policy is so neat, and this particular planning aspect of it that we may sort of overlook, is that a lot of times, and I review an awful lot of policies, life insurance policies, especially for you and your clients, is that life insurance is usually lopsided. Many times there's a primary income earner and a not so primary. And one person, that primary income earner, may have a lot of life insurance. Many times some of it's whole life. And so that person has a lot of cash values. The non-working spouse or partner, or smaller income earner, may have a much smaller amount of life insurance, maybe none at all. And so what do we end up having? We end up having somebody with $100,000 of cash value and somebody with 12. If we tried to do a 1035 exchanges to hybrid life policies with long-term care benefits, well, one's got $100,000 for cash value and one doesn't have enough for even the smallest amount of policy. So do they write a check to make the 16 and the 50 or 60 or whatever the minimum amount is, or the other person still has much larger benefits? So it ends up being lopsided, and so we try to correct that. The hybrid annuity, though, lets us even that out. We can take the primary earner's $100,000, transfer it to a hybrid annuity, and they both are eligible to receive long-term care benefits from that annuity at the same amount. So we're able to sort of even out the long-term care benefits, even though one has a much larger policy than the other. So in that case, we can take the cash values, transfer it to one policy. They both have long-term care benefits, and maybe the smaller policy, that $16,000, cancel it and surrender it and go on a cruise. Kind of something neat, but I think this is where I really sort of think this is a neat just concept, because the life insurance or existing policies oftentimes are so lopsided. So here's Carl. He's age 62 in Florida. He was declined for traditional long-term care insurance. Carl has a lot of things going on. Gastric bypass surgery, so you can see he's lost a lot of weight, looks pretty good. He's bipolar, eats edible marijuana once a week. So he was declined for traditional long-term care insurance, but is eligible for a hybrid long-term care annuity policy because it has streamlined underwriting. And he has an existing annuity, $150,000 cash value, $75,000 basis, $75,000 gains. So if they just earmarked this policy to pay for long-term care, we have $150,000 in this annuity, that's what I'm going to use to pay for long-term care if I need it. When you take money out of an annuity, you take your gains out first. So the first $700,000 or $75,000 he takes out is taxed as ordinary income to pay for long-term care. So that's not great either. But Carl has Carla. In this case, she doesn't have an annuity. And you as a financial advisor working with them, you say, I'd like you both to have long-term care coverage. We've earmarked or just sort of put aside this annuity, and that's our long-term care bucket. Let's repurpose this so that we can actually help protect both of you from long-term care or from needing long-term care. So we take $150,000 into a hybrid long-term care annuity. And there's really sort of two components here. And the cash value is about $150,000 at the end of the first year, which is pretty much the same thing as that LTC accumulation value. So I'm going to, just a second, give a little more explanation about how it works. But it's pretty much $150,000 of cash value and a LTC, and then an LTC extension for $180,000. So about $330,000 of long-term care benefits they can get from this annuity if they ever need it, at pretty much $5,000 per person per month. So if Carl goes on claim, he can use $5,000 up to $330,000, or $5,000 per month up to a total of $330,000. If Carl and Carla go on and claim at the same time, they can get $10,000 a month from the policy up to $330,000. Paying it out twice as fast because they're both on claim, still can get combined $330,000 from the policy. So how does this work? Basically, when you go on claim, you start using your own money first. So as you take money out of start receiving long-term care benefits from the annuity, the first thing you receive is your $150,000. So in a way, your $150,000 that you put in, that's your self-insure money. As I need care, the first $60,000 that comes out, this case for Carl, comes out of the cash value. If Carl got $60,000 of benefits from the policy and then he and Carla passed away, then the beneficiaries get $89,000, the remaining cash value. So it's like having $150,000 that I've set aside for care, same thing as the annuity that they might have. But if they use up that $150,000, then there's an additional $180,000 that they're using from the long-term care policy that's extra. That's the insurance company's money. That's the actual insurance. If we had the annuity, it's $150,000. If we use it, it's gone. Then got to go somewhere else. If we have the hybrid annuity, we still use $150,000 from the annuity. But if I use up the $150,000, then I have another $180,000 of long-term care benefits additionally, and that's the insurance part. That's the neat part about the annuity. So here, after 2 years of claim, the cash value, $30,000, haven't touched that long-term care extension yet because the first thing we're doing is using up our own money. So next year, Carl will, if he's still on claim, will use $30,000 from the cash value. Pretty much the cash value at that point is exhausted. Then he'll get $30,000 from that long-term care extension value. And now that's the insurance company's money. And so that's really the benefit. It's like having $150,000 that they're self-insuring with $180,000 secondary pool on top of it. So why would we do this? Well, one, it preserves $330,000 of other assets from being spent down for long-term care. If they just kept it in the annuity, his existing annuity, it's $150,000, but when it's gone, it's gone. In this case, it's $150,000, and when it's gone, wait, they still have another $180,000 to pay for care. Number two, this is pretty cool. If he just had the existing annuity and took money out, then it's going to be taxable as ordinary income. When you access or use the policy for the long-term care benefit rider and are actually receiving the reimbursements because of that, then the money that's coming out of the annuity is income tax-free. So it's a way to take what would otherwise be taxable or ordinary income, and if they need long-term care, it becomes tax-free benefits. Benefit of the annuity is also there's less underwriting for Carl, which is always a nice thing. We like less underwriting. And they get to share the policy together, kind of like this tandem bike that they're driving back from the bike shop. They get to share. So it's that, where I talked about, it's that way to take one policy and get them benefits for both and combine all that together. So for my wrap up, we talked about term insurance, disability insurance, life, universal life, long-term care, things to think about for the new year, and just some of the ways that we review. So it's just things to think about over the course of next year. As you're thinking about next year, we're doing our LIS Insurance Academy again, the end of February at the Clearwater Beach or at the Sheraton Sankey over on Clearwater Beach, which I think last year or the year before was rated one of the top 10, top 5, maybe number 1 beaches in the US. So I know I'm hitting some of you just right now when you probably are already tired of cold. Come to Florida in February. Listen to insurance. So really, it's a fun time. We do some fun things. So really invite all of you, if you're interested, to take a look at our registration. We're going to have 3 guest speakers, a disability insurance company underwriter, a long-term care company claims specialist, and a life insurance underwriter, and just have them talk to us about different things that they're seeing. And then for any of you who are new to LLIS or it's the first time you've tuned in, stay tuned next year. We do have sort of our David Letterman top 10 things that make us different. One is our monthly webinars. The free somebody typed in, I'm disappointed the wrap up didn't include rapping. You know, I thought about it, but I didn't think Claudia was going to let me do that. It wouldn't be good for anybody. So thank you, though. I appreciate the vote of confidence that you think I could have done that. Top 10 things. One is our free monthly webinar. Stay tuned for our schedule for next year. Number 2, we're not your competition. We only work with fee-only advisors to help them and their clients with insurance. We do a lot of work to help avoid surprises and save you time and your clients money. We have a lot of tools on our website. We are proud sponsors of a number of different fee-only financial planning groups, and will be again next year. It's great to work with such a great group of people who really are looking out for their clients, have their clients' best interests at heart, and it's fun every day to be able to work with you all and help get your clients on a better financial path. We have specialists in a number of different areas: life insurance, disability insurance, long-term care, annuities, hybrids. And as I mentioned, with some of the increased options on the disability policies, we help manage policies, help your clients put policies in place now. We review existing policies, but we're also here for the long term. And so we have our APEs, our advanced premium emails. And so for people with those quarterly payments, we're sending notices to let them know that those premiums are going to be coming due. Our notes are notification of term expiration. When your clients have those 10, 15, or 20-year term policies, in that 11th, 16th, or 21st year, those premiums are going to go up if they don't do anything about it. So we reach out to you and the clients to say, this level period is coming up. Here's some options. What would you like to do? Many times we hope that the idea is that they had a 20-year term policy and it just expires because it did exactly what it was needed to do. But if they might need new coverage, we can help with applying for a new policy. If they're not in good health, maybe converting the term policy. Lots of things that we can help with. And we have Alice, our 24/7 online advisor portal, and we're always looking for ways to improve that. So for you, those of you who are working with us or clients who are working, please let us know if there's anything that we can do to improve that. Our IT person, Dave, already has I think I've got a list of things for about the next 4 years of lots of, ooh, it would be cool if. So if you ever think of any, ooh, it would be cool if, let me know. And I see a few questions. A couple are maybe longer, maybe answers than I might be able to do here, but let me take a look. It's already, I'm already a couple minutes after 5. One question, any downsides to combining an annuity with long-term care? Are there any downsides? I don't really think of any downsides. It is a fixed annuity. Fixed annuity rates are fairly low, so it's not really going to have much growth because what the annuity does is it has some interest earnings and then it has some costs for that long-term care rider. So for the most part, the cash value stays pretty level. It's not going to, at least until rates start moving back up, not really going to grow very much. So it's just sort of sitting there. The cash value is kind of staying still. The long-term care extension is staying pretty still. But like I said, it's a good way to do that. There is a surrender charge period. But again, this should be something that clients are looking at maybe in their 50s, 60s, maybe even 70s, that we hope they don't need. Really, we hope they don't ever need, but if they do need it, it may be 10, 15, or 20 years down the road. And so then we have those, have those benefits out there. So, while it has a surrender charge, the goal should not be really to ever need or want or access it. All right, and to be respectful of everybody's time, I will go ahead and wrap up. If I didn't get a chance to get to your question today, I will reach out and email here in the next couple of days to each of you individually. And thank you all for tuning in today. I appreciate it. Have a great rest of 2019, and let's all have a great 2020. Hope everybody has a nice, safe, healthy, and happy holiday season.